Welcome back, traders. In today's video, we'll be covering 4 of the most powerful smart money concepts: order blocks, breaker blocks, mitigation blocks, and rejection blocks. Make sure you watch until the end, as we will explain how each concept works, what defines a valid block, and walk through real chart examples for clarity. As always, we appreciate your support. Please give this video a thumbs up and subscribe to the channel if you're new here. An order block represents the final footprint of institutional activity before a strong directional move in the market. In simple terms, a bullish order block is the last bearish candle that appears just before a powerful bullish impulse. This candle marks the point where smart money stepped in aggressively with buy orders, causing price to move higher. To mark a bullish order block on the chart, you draw a zone covering the entire candle range, from the low to the high of that candle. This zone represents an area where large institutional orders were placed, and often not fully filled. Because of this, price has a natural tendency to revisit this zone before continuing in the same direction. On the other hand, a bearish order block is the last bullish candle that forms just before a strong bearish impulse. This indicates aggressive selling by institutions. Just like bullish order blocks, bearish order blocks are marked by drawing a zone from the high to the low of the candle. One of the biggest advantages of trading order blocks is the tight stop loss, which allows for a much better risk-to-reward ratio when compared to traditional retail strategies. This is why order blocks are considered a refined and precise version of order flow. Not all order blocks are created equal. Based on their location within the impulse move, order blocks can be divided into extreme order blocks and decision order blocks. An extreme order block forms at the very origin of an impulsive move, typically at the lowest point in bullish market structure. This type of order block carries higher probability because it represents the final accumulation or distribution phase before price aggressively moves away. These zones usually contain significant liquidity and imbalance, making them powerful reaction points. A decision order block, on the other hand, forms somewhere in the middle of the impulsive move. While these can still work, they are generally considered lower probability compared to extreme order blocks, especially if price has already traveled a significant distance. Both types can be traded successfully, but extreme order blocks are preferred when precision and probability are the priority. To identify a high-probability order block, certain conditions must be met. Without these confirmations, an order block should not be traded blindly. The first and most important condition is a valid break of structure or change of character. Order blocks only gain significance after structure has shifted. In a bullish market structure, we look for bullish order blocks. However, if price breaks and closes below the previous swing low, creating a bearish change of character, our bias shifts. From that point onward, we stop looking for bullish order blocks and focus only on bearish order blocks. Similarly, in a bearish market structure, we look for bearish order blocks. But if price breaks and closes above the previous swing high, confirming a bullish change of character, we now focus exclusively on bullish order blocks. Without a confirmed structural shift, order blocks are not valid. Although order blocks are commonly defined as the last opposing candle before an impulse move, but it's not that straightforward. The candle color, red or green, itself is not the most important factor. What truly matters is that the order block candle should be a liquidity sweeping candle. This means the candle may be bullish or bearish, but it must be the lowest candle in a bullish setup or the highest candle in a bearish setup. No candle before or after it should break beyond its extreme. This confirms that liquidity has been swept, which is very important for a valid order block. Another critical condition is the presence of a fair value gap after the liquidity sweep candle is identified. A fair value gap is formed using a 3-candle structure, but an important point to understand is that these 3 candles are not always consecutive. Let's break this down. The first candle is the liquidity sweeping candle. After this candle, price may form one or more internal candles that remain within the range of the first candle. These internal candles do not invalidate the structure, they simply represent short-term consolidation. The second candle is the impulsive expansion candle that breaks beyond the high of the first candle in a bullish scenario, or below the low of the first candle in a bearish scenario. The candle that follows this expansion completes the three-candle formation and confirms the imbalance. In a bullish scenario, the fair value gap is the price gap between the high of the first candle and the low of the third candle. In a bearish scenario, it is formed between the low of the first candle and the high of the third candle. The presence of an FVG confirms institutional aggression and inefficiency, strengthening the validity of the order block. The final confirmation for a high-probability order block is inducement. Inducement refers to the minor pullback that forms after a valid break of structure. This pullback traps retail traders into early entries and creates liquidity. When price returns to take out this inducement level, it signals that smart money has gathered the liquidity needed to continue the move. Only after inducement is taken, we look toward the order block as a potential trade location. When price returns to a valid order block, there is a high probability that it will react from that zone and continue moving in the direction of the major trend. Order blocks are not standalone entry tools. They work best when combined with market structure, liquidity, fair value gaps and inducement. When all these elements align, order blocks become powerful zones and increases the probability of success. Now, let's move on to the next concept. A breaker block is a previously valid order block that fails and then transforms into a powerful supply or demand zone on the price chart. This shift occurs when price breaks through an order block in the opposite direction, causing that level to flip its role. We know whenever price breaks through a resistance level it becomes support. Similarly, whenever the price breaks through a support level it becomes a resistance level. The same logic applies to order blocks, but with greater significance because order blocks represent areas of institutional activity rather than simple retail support and resistance. When price decisively breaks through a bullish order block and closes below it, that demand zone loses its strength and becomes a supply area. This newly formed supply zone is called a bearish breaker block, and it is an area where price is likely to face rejection upon a retest. Conversely, when price breaks through a bearish order block and closes above it, that supply zone flips into a demand area. This is known as a bullish breaker block, where price has a high probability of reacting on a revisit. Now let's see what is the psychology behind the breaker block and how it works. Consider a bullish scenario where a bullish order block forms after a clear break of structure. Traders identify this zone as a buying opportunity, and long positions are executed when price returns to the order block. However, if price makes a change of character by breaking and closing below the most recent swing low, the bullish bias is invalidated and the market turns bearish. At this point, the original demand zone loses its bullish purpose and turned into supply zone. Traders who entered by positions from that order block are now trapped. As price moved below the zone, these traders hope for a pullback so they can exit their positions near break-even. When price returns to this area, thereby orders are closed, effectively turning into sell pressure. This sudden release of trapped liquidity fuels strong bearish momentum. At the same time, retail traders interpret the market structure shift as a confirmed bearish breakout. They wait for price to retrace so they can enter short positions from what they see as a retest of the broken level. These actions of trapped buyers and retail sellers at the same zone transforms the failed order block into a well-defined supply area. This is why breaker blocks often produce sharp, clean reactions and high-probability reversals. Now let's proceed to the next topic and see how to identify a breaker block. To identify a valid breaker blocks we need to consider several criteria and rules to use them to our advantage. The first condition is liquidity sweep before the market structure shift. In a bullish context, price must sweep liquidity above the most recent swing high before reversing. A candle close above the high is not mandatory for breaker blocks, but liquidity must be clearly taken. In a bearish context, price must sweep liquidity below the recent swing low before reversing. The second condition is that once liquidity is taken, price must start to reverse its movements. The third and most critical rule is confirmation through candle close. In a bullish market, a breaker block is only valid when price breaks and closes below the recent swing low. A simple wick or temporary penetration is not sufficient. The market must show commitment. This turns order block into a breaker block. Similarly, in a bearish market, price must break and close above the recent swing high to confirm a bullish breaker block. Finally, breaker blocks are considered one-time use zones. The highest probability reaction occurs on the first return to the breaker block. Once the zone has been mitigated, its effectiveness is significantly reduced, and it should no longer be treated as a high probability area of interest in the future. To integrate all the criteria and rules for valid order blocks, let's examine a real chart example. In this example, the market is clearly in a bearish trend, consistently forming lower highs and lower lows. After price breaks below the previous swing low, liquidity resting below that low is swept. Following this liquidity grab, price sharply reverses and moves higher. When a candle breaks and closes above the recent swing high, this confirms a valid market structure shift and validates the formation of a bullish breaker block. Once the breaker block is confirmed, it becomes a key area of interest. When price later retraces back into this breaker block zone, it presents a high probability opportunity to look for long positions. For entries, you can wait for additional confirmation based on your trading style. This could include lower timeframe candlestick patterns, a market structure shift, or other price action confirmations. These confirmations help refine your entry and manage risk more effectively. After price retraces into the breaker block, there is a strong probability that the market will reject this zone and continue moving higher, aligning with the new bullish direction. This is how breaker blocks allow you to trade with market structure and institutional flow rather than reacting emotionally to price movements. Now, let's take the next step and explore the next concept. When the market is trending upward, it naturally forms a sequence of higher highs and higher lows. During this process, price periodically pulls back to create a new swing low before continuing higher. However, when price fails to continue upward and instead breaks below that swing low, it signals a meaningful shift in market behavior. In this situation, the last down close candle, or the lowest candle of that swing low, becomes a bearish mitigation block. This zone represents the area where institutions begin mitigating, or closing, their previous buy positions, reducing exposure as the market prepares for a potential move in the opposite direction. In a downtrend, the process works in reverse. Price forms lower lows and lower highs, and each pullback creates a swing high where traders expect price to continue lower. But when price fails to break down and instead pushes above that swing high, the last up-close candle, or the highest candle of that swing high, becomes a bullish mitigation block. The color of the candle itself is irrelevant. What matters is that this zone marks where institutions are mitigating their sell positions, rebalancing risk, and positioning for a potential bullish continuation or reversal. At this point, you might be wondering whether a mitigation block is the same as a breaker block. The answer is no, and the distinction is important. A breaker block requires a liquidity sweep first. Price must run a swing high in uptrend or swing low in downtrend, trapping traders before reversing and breaking market structure. A mitigation block, on the other hand, forms without the need for a prior liquidity grab. It is based on trend failure and institutional risk adjustment, not retail stop hunting. In simple terms, a mitigation block is the footprint left behind when the market fails to continue in its expected direction and smart money responds by adjusting positions. Recognizing these zones allows you to identify where institutions have already been active, and where price is likely to react again. To understand how mitigation blocks work, you need to think from the perspective of trapped traders and institutional positioning. Imagine the market is making a series of lower highs and lower lows, clearly trending bearish. Most traders expect the next move to be a clean break of the recent swing low. Sellers become confident and enter short positions around the most recent swing high. Instead of continuing lower, the market fails to form a new low and reverses sharply, breaking above the recent high and confirming a market structure shift. This structural failure validates the formation of a mitigation block. Traders who entered short near the swing high are now trapped, sitting in drawdown as price moves against them. When price later returns to that same area, those trapped sellers are eager to exit their losing positions at break-even. At the same time, new buyers recognize the failed bearish structure as a potential bullish reversal. This combination of trapped sellers and fresh buying creates strong momentum, pushing price higher. This is why mitigation blocks often produce sharp and decisive reactions. They represent zones where emotional retail decisions and institutional risk management collide, and institutions use that liquidity to drive price efficiently. Now, to identify a high-probability mitigation block, we need to consider several criteria and rules to use them to our advantage. First, price should react from a major reference level, such as strong support, resistance, supply, or demand. These levels attract institutional attention and provide the environment where mitigation becomes meaningful. Second, the core concept behind a mitigation block is swing failure. A valid mitigation block forms when price attempts to continue the current trend but fails. For example, in a downtrend, price tries to break the previous swing low but instead reverses and pushes higher, signaling that sellers have lost control. Third, this failure must be confirmed by a market structure shift. The break of recent high in downtrend or recent low in uptrend validates the change in direction and confirms that the prior trend is no longer in control. Once this happens, the last up-close candle of the failed swing high becomes a bullish mitigation block. Mark the zone from the wick high to the wick low and extend it to the left. Finally, one rule must never be ignored: a mitigation block is a one-time opportunity. Once price returns to the block and mitigates the remaining orders, its job is done. Institutions do not defend the same mitigation zone repeatedly. After the first reaction, the level loses its significance. A valid mitigation block is not defined by a single candle alone. It is the result of trend failure, structural confirmation, and institutional positioning. When these elements align, you gain a level that offers both logical reasoning and high probability, exactly what smart money trading is about. Now, let's bring everything together with a real chart example. Here, we're looking at a 15-minute chart of gold. Initially, price is clearly in an uptrend, consistently forming higher highs and higher lows, which confirms bullish market structure. As price continues higher, it eventually taps into a higher timeframe supply zone on the 1-hour chart. This level acts as a major reference point, and price reacts strongly from it, signaling potential institutional interest and the possibility of a shift in direction. Next, price attempts to continue the uptrend by pushing above the recent high. However, instead of sustaining that move, it fails, creates a new low, and then breaks below that low. This break confirms a market structure shift from bullish to bearish. At this point, the lowest candle of that failed swing low becomes our bearish mitigation block, marking the zone where institutions are likely mitigating previous long positions and initiating short exposure. When price later returns to this mitigation block, it provides a high probability opportunity to look for short entries. For execution, you can refine your entry using lower timeframe confirmation, such as a minor market structure shift or a clear bearish candlestick pattern. The stop loss should be placed above the mitigation block, keeping risk controlled, while take-profit targets can be set at the next significant demand zone or key liquidity level. This approach allows you to align your trades with institutional behavior, using structure, context, and confirmation, rather than guessing reversals or reacting emotionally to price. With that covered, let's shift our focus to the next concept. A rejection block refers to a price area where the market attempts to break a key level but is aggressively rejected, leaving behind a prominent wick or shadow on the candle. This rejection shows that price was not accepted beyond that zone, signaling strong opposition from smart money or institutional participants. When a long wick forms at a swing low, support, or demand zone, it is referred to as a bullish rejection block. Conversely, when a long wick forms at a swing high, resistance, or supply zone, it is called a bearish rejection block. A rejection block can be formed by a single candle or a series of candles with extended wicks. The key point remains the same: the market attempted to move beyond a critical area but failed to sustain price there. To accurately identify and mark a rejection block, we focus on a three-candle sequence that forms near an important area of interest. The first candle is an impulse candle, which drives price aggressively toward the key level. This candle often sweeps liquidity or manipulates price, drawing in breakout traders and stop-loss orders. The second candle is the rejection candle. This is the most important candle in the sequence and is characterized by a sharp rejection and a long wick. The wick represents the point where smart money stepped in and absorbed liquidity. The color of this candle is irrelevant, what matters is the rejection itself. The third candle is the confirmation candle, which closes decisively in the opposite direction. This candle confirms that control has shifted to smart money and that a potential reversal is underway. For a bearish rejection block, the high of the middle candle must be higher than the highs of the surrounding candles. Once these conditions are met, the entire upper wick of the rejection candle becomes the rejection block zone. In some cases, the confirmation candle may have an even longer wick. If that happens, the longest wick in the sequence should be used to define the rejection block. The same logic applies to bullish rejection blocks, where the low of the middle candle must be lower than the lows of the neighboring candles, and the lower wick defines the rejection zone. Now let's move on to the next topic and understand how rejection blocks work. When price reaches a key area of interest, this is where institutional participants become highly active. At these levels, smart money often absorbs the remaining liquidity by placing large orders against the prevailing move. This sudden influx of institutional orders prevents price from continuing in the same direction. As a result, the market reacts aggressively, creating a sharp rejection and leaving behind a long wick on the candle. This wick is not random or accidental. It represents the precise price zone where institutional interest was strongest and where smart money stepped in to control price. When price later revisits this same rejection zone, it often reacts again. This happens because smart money may either defend existing positions or execute the remaining portion of their orders. Because of this behavior, rejection blocks often act as high-probability reaction or reversal zones, providing traders with a clear visual footprint of institutional activity and a well-defined area to look for trade setups aligned with smart money. To identify a rejection block with a high probability of success, several conditions must align. First, there must be a strong and clearly visible wick formed at a meaningful area of interest, such as swing high, swing low, support, resistance, supply, or demand. The larger and cleaner the wick, the stronger the rejection. This wick indicates aggressive absorption of liquidity and rejection of higher or lower prices. Second, rejection blocks are usually accompanied by an impulsive move into the level, followed by an equally sharp move in the opposite direction. This sudden reversal shows that institutional orders were filled and that price is now moving in the intended direction. The speed and strength of the reversal often indicate that retail traders were trapped on the wrong side of the move. Third, a noticeable increase in volume often strengthens the validity of a rejection block. High volume during the rejection candle or confirmation move suggests strong participation from large players. This increase in volume confirms that the rejection was not random price action but the result of institutional involvement and order execution. When all these elements come together, a rejection block becomes a powerful tool for identifying high-probability reaction and reversal zones. When price taps into such high-probability zone, there is a significant chance that the market may reverse and start moving downward from that level. Now, let's examine a real chart example to understand this concept clearly. In this chart, we can observe that once the price reaches the demand zone, it reacts strongly and begins to move higher. This move is followed by a break of structure, which signals a momentum in favor of the buyers. As the price moves away from the demand zone, it leaves behind a long lower wick. This wick clearly represents bullish dominance, showing that buyers aggressively stepped in and rejected lower prices. We mark the entire wick area as a rejection block, as this zone highlights the exact price range where strong institutional buying occurred. When the price later returns to this rejection block, there is a high probability that it will react again and reverse upward, as smart money may defend their positions or complete remaining orders. For trade execution, we do not enter blindly. Instead, we wait for confirmation, such as a clear candlestick pattern or a market structure shift on a lower time frame, before entering a long position. The stop loss should be placed safely below the low of the rejection block. For take profit, target the next significant high or key resistance level, ensuring a favorable risk-to-reward ratio. That's it, traders. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon so you never miss our next video. If you have any question, drop it in the comment below. Thanks for watching, see you in the next video.